Hello, YouTube. We're going to talk today about whether or not the stock market rally is over because we're noticing upper wicks on SMH, the same thing we saw during the last sell off. And after we were unable to hold the lower low, meaning we went to a lower low, that's what happened. We went down. So far, we got 1, 2, 3 weeks in a row or two candles, which give us lower weekly lows. And we have that same upper wick here. So if this is a real dump, we're going to find out pretty soon because over here on QQQ, we know that we noticed that we're looking at the same pattern. We are looking at lower lows. Last week it was higher lows and higher highs. Well, this week it's not. We've now printed a weekly lower low, and if we can hold, and if we don't revisit the low, this is a failed breakdown and could lead to a hammer, which means that we could form an upper hammer for the upper part here and go up. That would be the fake rally. That'd be the fake dump, sorry. So I think we got a lot to go through, but let's look at one more quick chart. It is SPY on the seasonality chart, and that is because when we look here to QQQ, we noted this earlier that after the S&P stopped going up, it just started going completely sideways. So QQQ has been going absolutely nowhere ever since the beginning of the month. So it's been doing a whole bunch of nothing, a nothing burger. We look over here to SPY or the S&P 500. What do we notice? Oh, okay. Well, it's just starting to do what QQQ has already done. That's right. So it just means that it's starting to lose its angle of ascent or the angle of ascent or the uptrend, however you want to think about it. I still think we're going up because, well, first of all, we're not going down. So we look at our downtrend, right? That's our downtrend. It's clearly been broken. We back test and pass on it. But if we're going to be going up at this angle of ascent, it is time for us to break out. It is time for us to not go sideways, but up. So if the market is not going down and not going up, what could it be doing? Well, it could be going sideways. So in my opinion, sideways is going to be bullish because it just means time on the clock. The pain trade is currently up. The market's currently in greed. So if the market's in greed and there's a record short going back to 2011, man, all we got to do is just go sideways. And if we look here, as long as we hold this relative low, that's where we could be looking for a back test to. If we back test here, I would probably call that about, we look here objectively to the S&P, I'd probably call that close to, I don't know, about 408. It could come down lower. So I would say between 402 or the 50 DMA and about 408. That'd be a nice area for us to back test to if this is not going to be it, meaning we already put in our weekly lower low. Sorry, higher low. Because when we look here to SPY, what is so interesting on the weekly candle for this one is that it got close to printing a new low of the week, but it did not. 410.17 last week, 410.6 this week. That is a 43-cent higher low. All right, let's look at the next headline here. Is it a bull market or a bear market? Stocks churning in same spot for weeks frustrates investors. And I'm going to ask you for a huge favor, please and thank you. It's going to be to smash that thumbs up and consider subscribing to the channel if you're enjoying the content. Let me just see if I can get that overlay. There we go. Thank you, beautiful people ahead of time for getting that done. We appreciate you very much. And I have a quote for you at the end that as I am getting ready to leave in May, I'm going to tell you what that is and how you can get prepared. So make sure you watch all the way till the end. So is it a bull or bear? Well, this is like a hard question right now. We note that we also have, where's the next thing I want to pull up here? Here we go. We got everyone fighting. We got Wall Street Elves saying 4750 or Tom Lee, and we got Michael Kantrowitz saying 3200. What that basically means is that it's a tough market right now. This is a chart that Mason shared, so thank you to him. This is from Bank of America. It tells us that the net percent overweight equities versus bonds is not at a level we've seen since 2020 or 2009. So yes, it is hard to know if it's a bull or a bear, but people are underexposed, like the bear is going to prevail. And with big tech, $5 trillion or 40% of the S&P 500 reporting this week, including Microsoft, Alphabet, Meta, Intel, Amazon, right? Those are big companies. So what does that mean? Well, let's hear from a bear. This is the resident bear at Morgan Stanley, Mike Wilson, telling us that earnings are the next risk to equities. He told us this a month ago. Where do we go? Sideways on tech, higher for the market. Given the events of the past few weeks, we think guidance is looking more and more unrealistic, and equity markets are at a greater risk of pricing in much lower estimates ahead of a hard data change. What does that mean? Well, if we look here to big tech's adjusted EPS growth year over year, it is red for who? Meta, Google, Netflix, Apple, Amazon. Microsoft is green. What does that mean? It means when you see a company like Netflix beat on revenue, it's because they lowered the bar last quarter and then they beat the lower number. The lower number was 9.1% lower. So let's remember this means that we've already had a negative quarter from big tech. And as we get more of them, it's also important to focus on those regional banks. First Republic was a big one in focus. It was up by 12% today. You won't even notice it though because we're so low on the chart. Let's put in a log scale and see. Nope, doesn't even make it any better. So let's zoom in a little bit closer here for those boomer eyes, please and thank you. And if you guys wouldn't mind smashing that thumbs up, let's go. There we go, log. So it came off the bottom, but it was soft and it was not long-lived. Up by about $1.70 in trading today, down by $1.20. So what I'll be looking for is not just what Mike Wilson just told us. Again, what he told us was that in the last few weeks, this was a month ago, basically meaning after SVB, we think guidance is looking more and more unrealistic for big tech and for the broader market. Well, so far that's incorrect. And so far we got 40% of the S&P reporting this week. So wherever we close out the week, I just showed you S&P held the low. QQQ did not. So if those levels hold or don't hold, that is what really matters. The last calendar day of the month is going to be on Friday. So we're closing out the weekly and the monthly on Friday. So that's really important because what we talked about on the weekend in regards to the monthly levels. Here for FRC, they missed hugely on deposits. They missed on a few other things, but their earnings beat. What happened here? Why is it down? Well, because they said we're seeking strategic options, which is what you say when you're like, oh my God, everything's fine, but we need to get bought out. So it's been over a month now. There has not been a buyout offered yet. Tom Barrick was supposed to be in discussions to do some kind of help. Nothing's happened yet. So does that mean there's no one to lend to them? Or is this another shoe that could drop? Well, Mike Wilson thinks so. All right. So we know the bear case. We talked about that on the weekend too. Technically, here's the other part. So pricey could get even more pricey. Technology stocks are nearly the most expensive relative to the broader market they have been, going back to the dot-com high when they were priced at 3.0, which means there are $3 in premium for tech stocks relative to the broader market. Here we go. Mike Wilson drumming up the bear drum again today. Here we go. Morgan Stanley sees risks to stocks from earnings and from the Fed. U.S. stock indexes traded unusually well into earnings season. It's unusual because they're not positioned long. That's what they don't like. If it was going higher, they'd be like, oh, yeah, hell yeah. Make that money. 7% year to date. Let's go. That's what it comes down to. And then over here, we got this is Peter Oppenheimer from Goldman Sachs telling us that all major economies will avoid a recession. It looks like he's smirking over at Morgan Stanley, telling them, hey, we might have missed this earnings report, but watch out, boys. We're coming. We're going to beat. We're going to do well. All right, a few more quick things here. So what I noted earlier in the week was, I think on the weekend we talked about QQQ forming that weekly lower low, but like technically it's still going up on its last uptrend. I cannot draw another one after this. So it's like do or die here for QQQ. SPY, it's just starting to go sideways. So the sideways period could be from, I think we were looking here at about roughly April 10th. Well, here we are 3 weeks later. Man, that's boring. That's frustrating. Yep. It's the one article we showed you about it being very, very frustrating. Gold is up back to 2K. Bitcoin is down. So it's down to 27,400, right around that 50 DMA. See if it can bounce. We know we got big tech earnings coming out this week, so we're not going to focus too much on those until they actually report. But looking over here at IAT, which is that regional bank ETF, I am noticing some softness here. So what we're going to do is what we did last week, looking at hollow candles. And what do we note? We got 3 reds in a row, 3 full reds, and 3 full just mean we're closing lower than we opened. So let's see what happens tomorrow after FRC and other regional banks. Are we going to gap up? Are we going to gap down? Or are we going to go sideways for longer? That is a key focus for me. Otherwise, we note ARK is soft, just like it's been before. SMH below that 50 DMA is not a good look. ARK is just crap. No golden cross, right? Rejected on the golden cross. It looks soft, right? Maybe Kathy needs to invest in some Viagra. Get that stunk up. Anyways, I'm going to leave it there. If you want to see more, I laid out everything on our weekend deep dive. Thank you so much for tuning in. I look forward to seeing you tomorrow.